Good afternoon, everybody. This is Jason Bowman, and welcome to this presentation of an overview of IRS collections representation. Before we get started, I just want to let you know certificates of completion, I'll get those done over the weekend, as well as the IRS CE reporting to receive your CE CPE credit. You must answer all 3 polling questions. This is usually an issue for the EAs because you're not necessarily used to doing this on some of the IRS webinars and whatnot. But NASBA has stricter requirements than the IRS does for CE completion, so you got to answer the polling questions. The handouts, the slides for today's presentation are available in the reminder link that were sent to you by GoToWebinar. They are also available in the handouts pane of the GoToWebinar control panel. If you can't find it, just click on View, then Handouts, and then you can download it. If you have questions during the presentation, don't hesitate to ask via the questions pane. So the presentation that we're doing today is kind of a Frankenstein, actually. What I did is I went through all the slides for our level 1 and level 2 presentations, each level comprising an entire day in a live seminar format, and I picked out what I felt were the most important elements for somebody to see if they were getting into tax resolution for the first time, if they were thinking about getting into collections representation, if they just wanted a big picture, 35,000-foot survey overview. And so that's kind of what I've created here for you, is the equivalent of a survey class in college, where we're not going to go in depth on any one particular thing, okay? So please keep that in mind before you start asking questions. The purpose here is not to go in depth on any particular area. What I want to give you is exactly what I promised, a sweeping overview of the IRS collections process. So that starts with taking a look at what IRS collections activity looks like. Now, this information is something that I look forward to every single year. In fact, it's the annual IRS publication I look most forward to, and it's from the IRS data book on the preceding fiscal year, and this usually comes out around March, end of March, early April of each year. And Table 16 is the piece that I am most interested in, because Table 16 shows the IRS collections activity. So in fiscal year 2016, and the fiscal year, don't forget, runs October 1st to the end of September of each year. So in FY16, there were over 7.5 million new collections cases opened by the IRS. Now, they also closed 7 million collections cases, either because they were entered into via installment agreements, they were closed out as non-collectible, collection statute expiration date expired, the 10-year statute of limitations ran out, etc. So we started fiscal year 2017 with 14 million open IRS collections cases, a net increase of over 634,000 cases over the previous year. Now, don't forget, this is not the tax gap, which is an estimate of underreporting. Nay, nay. This is actually representing assessed tax penalties and interest. So assessments that have already been made. And currently over $138 billion outstanding. And for reference, that is twice the annual budget of the U.S. Department of Education. Taking a little bit further look at this, in 2015, there were over 3 million delinquent tax return case investigations open. The IRS has been doing a special enforcement the past couple of years, special enforcement initiative, to reduce the number of open collections cases, okay? And yes, Stephen, if they're in C&C, the case is currently considered closed unless it comes up for review, then it opens up again in collection. So these delinquent return investigations are dwindling because obviously the IRS needs to know how much somebody owes in order to bill them. That's why the failure to file a return is a crime, whereas we did away with debtor's prison many, many moons ago. So the failure to file is potentially a crime, whereas the failure to pay isn't necessarily so. Also want to point out that the number of tax liens being filed every year is literally half what it was when I got into this industry in 2008. Almost 1 million tax liens filed in 2008, well under 500,000 filed in 2016. This has to do with some changes in filing thresholds from the IRS Fresh Start program, but it also has a lot to do with the budget crisis, right? The IRS has to pay state and local county filing fees in order to file that 668Y, okay? So the number of tax liens being filed on public record is dwindling. Also, the number of levies being issued is decreasing. In fact, last year was the single biggest decrease in levy issuance since I started in the industry. And Paul, this industry, I'm talking about the tax resolution service industry as a whole, okay? It is an industry unto itself, okay? It is a subspecialization and a niche of practice within the overall tax and accounting industry, okay? So that's what I'm referring to. The biggest thing that I want to point out here is that last year the IRS accepted 27,000 offers in compromise out of 63,000 applications, okay? Now, yes, that's over a 40% acceptance rate. The other 60% mostly represent offers in compromise that should never have been filed in the first place. I personally have a 100% offer in compromise acceptance rate because I didn't run an offer mill. I only submit offers that they qualify for, okay? So always run the numbers, make sure that they qualify for the OIC before you ever submit it. A lot of offers being submitted are either by people that don't read the form, okay, and so don't actually qualify, or they're submitted by offer mills that are out there, I call them the big national scumbag rip-off con artists of the industry. Those firms that are out there selling everybody the pennies on the dollar dream, and saying, yeah, we can sell your tax debt for $100. Not a problem, okay? So a lot of offers get submitted by those con artists out there that are out there ripping taxpayers off. The key point here is 27,000 offers accepted out of 7 million collections cases that were closed out, okay? That, I think, is pretty important, okay? So again, 7 million collections cases closed out. I've never used the highlighter before. I didn't know that worked, okay? So compare that to the 27,000 offers that were accepted. That is a 0.38%, okay? Less than 0.5% of tax debt cases are resolved through a reduced settlement, okay? Bottom line, tax resolution does not equal offers in compromise, okay? That's why in our level 1 full day seminars, we don't even talk about offers in compromise because it is the least useful, the least important, and the least utilized resolution tool at your disposal. So for those of you that haven't had any prior exposure to this whole industry in general that we call tax resolution, if you're coming into it thinking that it's all about offers in compromise, I want to kind of knock that out of your noggin right off the bat, okay? So where do tax debts come from? I would hope that I don't have to spend a whole lot of time on this. I would expect that most of you would already realize that assessments come from either the filing of a return, they come out of examination, and they can also come out of the substitute for return, SFR, substitute for return program. Now, after both a SFR is filed by the IRS, or any changes are made by examination, there is a SNOD issued. This is the 90-day letter, the statutory notice of deficiency, SNOD. And then 90 days after that, the assessment becomes fixed. Now, of course, there are additional penalty assessments and various other avenues, but these are the primary ways that a tax debt gets issued. All right, before we get too far along here, let me put up our first polling question. And remember, EA is included. Must answer the polling questions. And Stephen, yeah, unfortunately the OICs are what are most advertised by the big national fly-by-night companies. That's what's advertised, but that is obviously not what most people qualify for. Hardly anybody does, okay? This isn't a marketing webinar, but the benefit of all those big companies doing all that marketing is that over the past decade plus, it has raised public awareness of the fact that there are resolution options. So it actually helps to start the conversation, and it helps make your advertising that much more powerful and gives you something to launch off of. You know, especially when everybody else, you know, you get to say, I know everybody out there is promising you this pennies on the dollar thing, but I want you to know that if you pay them money and you hire them, you may not qualify for the offer. Less than half of 1% of all taxpayers do, okay? All right, so we're at 90% on the polling question. Need to get the rest of you in there. It's about 5 or 6 people. Looks like most of you want the pass-through entity class. That's interesting. All right, 5 more seconds on the polling question, and then it's gone. If you don't answer this one, well, you're not going to get all 3, and you're not going to get credit. So 3, 2, 1, and bye-bye it goes. All right. So what is this thing that we call the IRS Collections Cycle? You obviously know that the IRS is very forms-driven, they're notice-driven, they're checklist-oriented. I'm a firm proponent that everybody should spend time reading the Internal Revenue Manual, and once you start reading through the IRM, you quickly realize that it's just a big book of checklists, processes, okay? So the IRS runs off of processes. Now, the IRS is required by law to send at least 1 notice and demand for payment. That's a bill. By administrative courtesy, they send 2. Okay, and I've got a typo here. This should be NFTL, not NTFL. That's the Notice of Federal Tax Lien. So after an assessment, there's a bill, they send another courtesy bill, and then if the liability is over $10,000, they'll typically file the Notice of Federal Tax Lien. 30 days after that, you get the first Notice of Intent to Levy, the CP 504, which is also the only required warning indicating that they can take your state tax refund. 30 days after that, if it's in the field, it'll be a letter 1058. If it comes out of ACS, a service center, it'll be a LT11. That is the final notice of intent to levy. And just like by law, the IRS is only required to send 1 bill. They are only required by law to send 1 notice of intent to levy. They send 2 as a courtesy, okay? Because we all know that the IRS is a gentle, gentle creature, right? So understand also that most tax debtors have been through the process at least once. The majority of 1040 debtors owe for anywhere from 3 to 5 years. That's the typical 1040 case. And then this is obviously an annual cycle. A lot of these, most people have gotten their bills by now. Right now, as we sit here at the end of June 2017, a lot of these notices of federal tax lien are going out on returns that were just filed in the latest filing season. and pretty soon we'll be getting the CP 504s. So right now is what I refer to as second tax season or tax resolution season for the 1040 side of the house. I should also point out that over 60% of that $138 billion in outstanding tax penalties and interest is actually 941. The bulk of the money owed to the government is 941, not 1040. That is where the bulk of the money is to be made in this industry. And again, Paul, by this industry, I mean tax resolution. The other nice thing about 941 and focusing on 941s is that they are the highest SBSE enforcement priority, because federal tax deposits are what fund the day-to-day cash operations of the federal government. And they're on a quarterly cycle. So you'll notice that this cycle right here lasts about 4 months. 941s run on a 3-month cycle. And so for a 941 debtor that continues to accrue a tax liability, they are forever in this endless vicious loop of this cycle. So the key to breaking, the key to resolution is breaking this cycle, especially on the 941 side, where it comes up so frequently throughout the year. Now let's talk about those tax liens. This is covered by Section 6321 of the Internal Revenue Code, which is under Title 26 of the U.S. Code, which states that if any person liable to pay any tax neglects or refuses to pay the same after demand, the amount, including any interest, additional amount, addition to tax, or assessable penalty, together with cost of collections, shall be a lien in favor of the United States upon all property and rights to property, whether real or personal, belonging to such person. So, if you owe the government money, they have a lien against everything you own, or everything you have a right to, okay? Including, what's a future paycheck? That's rights to future property, okay? So that's the statutory basis for wage garnishments, for example. Now, here's the other part of the lien puzzle that a lot of practitioners even don't fully realize. And this is in the very next section of the code. Unless another date is specifically fixed by law, the lien imposed by the prior section shall arise at the time the assessment is made. At the time the assessment is made. So the lien, the statutory tax lien, that arises against a tax debtor arises the very instant that an assessment is fixed. So after the IRS processes a tax return and issues the assessment, there's a tax lien. 90 days after the statutory notice of deficiency issued via an examination or SFR process, bam, there is a lien. The IRS does not have to file the notice of federal tax lien in order for there to be a lien, okay? Some people call it the secret lien or the silent lien. It's definitely not secret and it's definitely not silent, okay? It is a statutory lien, and you as a tax professional need to know that that lien exists against anybody that owes the IRS money, even if the 668Y has not yet been filed. Now, why should you care about liens, all right? Lien work, as I call it, which includes lien withdrawals, subordinations, discharges, etc., will be central to approximately 5 to 10% of your case resolutions if you are doing a large volume of tax resolution work. Okay, remember, this is all I did for 8 years, was I was strictly tax resolution. Okay, I didn't do seasonal tax prep, I didn't do examination, I'm a one-trick pony, and that's collections. Okay, a lot of times you can get a tax lien withdrawn or discharge an asset or subordinate the tax lien in order to facilitate collection. And we talk about this for 2 full hours in our level 2 tax lien class. Also note that any real estate transaction involving a tax debtor is going to require your assistance. This is a great referral marketing opportunity for you with mortgage brokers, real estate agents, etc. And there is an entire business model that you can have where all you're doing is lien work. Okay? And of course, all taxpayer assets are subject to the lien and require IRS permission to finance, refinance, or dispose of the asset. Generally, the government has 10 years to collect on the debt. This This starts the date the assessment is made and runs for 10 years until the CSED, Collection Statute Expiration Date. If the IRS does file the Notice of Federal Tax Lien to put it on public record, that is a self-releasing document. So it's got a date on it, and 30 days after that date, the lien self-releases. Okay. Now, in the rare circumstance, very rare, where the government sues the taxpayer in state court and reduces the tax debt to judgment, then the CSED kind of goes out the window, and the judgment expires under state law. And so check your state laws on this. Well over half the states have a judgment time period that lasts for 20 years or more. Okay. Also note that there are administrative actions that can extend the 10-year period of time. For example, if you file an offer in compromise, the clock stops. If you file a CDP appeal, the clock stops. If the taxpayer files bankruptcy, the clock stops. If the taxpayer is overseas for more than 6 months, on that 183rd day or whatever it is, boom, the clock stops. Okay. There are other CSED extenders, refer to IRM 5.1.19 for the exhaustive list. But the ones that you see here on the slide, these are the predominant ones you need to be aware of. So what is the difference between a tax release, a tax lien release, and a tax lien withdrawal? The release is a formal public notice of the release of the statutory lien under 6321, the section of the code we already talked about. The way that the release looks on a credit report, for example, is it will show the tax debt was there and then it was paid. Okay, but the tax lien is still on the credit report. Okay. To remove the adverse public impact of the NFTL, there's another typo, man. What you want is a 10916C from the IRS, which is a withdrawal. What this does is you send it to the credit reports, the credit bureaus, and they actually delete the tax lien entry from the credit report entirely. And that removes the entire adverse impact. And again, we cover lien withdrawal processes in our level 2 program. So next I want to talk about resolution pathways. This is something that I created as kind of a handy reference for myself, something I'd encourage you to kind of embody within your tax resolution practice as well. It's a very basic flow chart showing the options that a taxpayer has at their disposal. So, if the taxpayer has assets and they are beyond streamlined criteria, meaning they do not qualify for a streamlined installment agreement, the IRS is going to expect that the taxpayer attempt to tap into equity they have in assets. Okay, so it's a good idea, again, if they are not streamline eligible, that you get 2 or 3 loan denial letters in advance because a revenue officer is going to ask for them. You also may need to be looking at lien discharge, withdrawal, or subordination processes so that you can refinance or sell assets. Assuming that there's no assets to tap into, or if the taxpayer is eligible for streamlined installment agreements, then what you need to be looking at is their disposable income. The proper IRS term is remaining income, but most of us is under the collection financial standards. Okay. Now, for a business, obviously the collection financial standards don't apply, but you're allowed reasonable and customary business expenses instead. The trick to minimizing an installment agreement payment is to maximize the allowable expenses and minimize income. and we talk about some perfectly legal, perfectly legitimate, perfectly ethical tips and tricks to help you do this in our level 1 class. Now, if the taxpayer has no assets and no disposable income, then chances are they're a CNC candidate, currently not collectible, status 53. Okay? And then, of course, throughout this whole process, if the taxpayer has less assets than the tax debt, and they can't full pay the liability under an installment agreement, then the question is, well, might they be eligible for an offer in compromise? Okay? Don't forget that the formula for the offer in compromise is the quick sale value of their assets minus any encumbrances, plus the taxpayer's disposable income times either 12 or 24 months, depending on which of the two doubt as to collectability payment plans they're going to be under. If the sum of those assets and the disposable income over 1 or 2 years is less than the debt, then they may be OIC eligible. Okay? However, bear in mind that the 2012 Fresh Start changes that reduced this multiplier from 48 and 60 down to 12 or 24, and that also allows credit for credit card payments and student loan payments, that was a 2012 change that can be rescinded at any time. So if your taxpayer, your client is interested in the offer in compromise program, get them in and do it now in order to get them into the better offer in compromise climate that we're currently in and have been for about 5 years now. But I would expect those changes to be rescinded at some time in the next few years. Okay? Don't forget that the resolution pathway that they're eligible for is based primarily on their financial condition. Now here I'm going to be talking primarily about 1040, okay? Because that's where this really applies the most. Form 433A, Section 5, this is the income and expense table. The IET is what you'll hear it referred to within the OIC world. This is where the collection financial standards are actually applied, and this is what determines the monthly installment agreement payment or the offer in compromise remaining income that goes into the RCP offer calculation. Okay? And this is what that looks like. Now, when you're looking at this, you have to take your tax preparer hat off. Okay? You have to take your tax preparer hat off, because what this is an actual cash basis personal budget is what it is. It's a cash flow statement, okay? Income statement. So, for example, child support is not taxable income. And so if you're wearing your tax preparer hat, you're going to look at this line 30 and be like, well, child support's not taxable, that doesn't go on there. Wrong. It does go on the form, because even though it's not taxable income, it is still cash available to the taxpayer to pay their bills, okay? So again, take that hat off. It's the same thing when you're looking at a 433B. You know, for a tax return, you're going to take half of the meals and entertainment. You don't do that on a 433B, because it's not the tax basis, it's the actual cash outflow. So it's 100% of meals and entertainment that are allowable, okay? So you should become intimately familiar with this form. I even recommend that you have copies of this grid that are just on a blank 8.5 by 11 piece of paper, and I routinely use them as scratch paper for when I'm doing consultations. It helps do back of the envelope calculations for clients. Okay. Briefly, the purpose of the financial standards. Never forget that the IRS sets the collection financial standards based on a middle class income, based on a lot of statistical inputs. Okay. They use the remaining income amount to calculate the installment agreement payment, calculate your offer and compromise amount, and even determine eligibility for currently not collectible status. Okay. So in other words, the vast majority of our resolution options for 1040 cases depend entirely upon what's on this part of the 433A. Okay. Real quick, let's get to our next polling question. Why did the chicken cross the road? Was it A, to avoid lame and outdated jokes? B, because Popeyes was on her side of the street? C, to seek solace and meditate? D, to prove to the squirrel that it could be done? Or E, because dag nabbit, this is America, and a chicken can go wherever a chicken wants to go. Don't forget, polling questions do not have to actually apply to the material being taught. And be glad that you guys are not in the, I affectionately refer to it as the dad joke era. And that was all of 2016, where all polling questions were really, really bad dad jokes. I do my best to lighten up the CPE train, make it a little bit more fun. All right, give you 10 more seconds. 10 more seconds. 5, 4, 3, 2. Ding, 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 ding. All right. So let's talk about IAs. Again, why should you care about installment agreements? Well, it's because hardly anybody, okay, less than 1 out of every 200 tax debtors will resolve their case through an OIC. Okay, ever since the Offer and Compromise program was created in 1965, yes, the OIC was originally created in 1965. It has always been the least common option due to the strict eligibility criteria. Roughly 15% of tax debtors will be placed in CNC. 5 to 10% of them will involve either full pay or something involving their assets. Everybody else, over 75% of the cases you work, will be resolved through a payment plan, whether the taxpayer likes it or not. Okay, that's what they're going to be eligible for. And so this is your workhorse. Installment agreements are where you make your living. Okay, so that is why you should care. There are 6 different types of installment agreements. It would take a full 2 hours for me to go through all 6 of them, but of course we cover that in our level 1 class. We have an entire 2-hour session on IAs. So there's the guaranteed installment agreement, which has the $10,000 income tax cap. There's the streamline installment agreement, which according to IRS data, 90% of taxpayers on an IA are on the streamline program. And that number has gone up because for 2017 only, this expires at the end of the current fiscal year, so in September, they've upped the threshold amounts. For 1040 debts, it's $100,000. And then for they've adjusted the lien filing threshold as well. So there's some good things going on with the test criteria for streamline installment agreements. For businesses that owe trust fund taxes, particularly payroll trust fund taxes, there are 2 types of in-business, so business is still operating, in-business trust fund installment agreements. The in-business trust fund express installment agreement has a $25,000 cap on the liability. The regular in-business trust fund installment agreement does not have such a cap, and both of these programs are great because they provide an option for the operating business to full pay the liability and help avoid a personal assessment of the trust fund recovery penalty. Because the IRS has all these specially named type of installment agreements, they had to come up with a different name for just a normal installment agreement, and so they called it a regular IA, you know, because it's regular. So nothing special about it, all right? So if you don't qualify for any other types, you're in a regular installment agreement territory. There is also something called a partial pay installment agreement. This is when the taxpayer can only afford X dollars a month, and that there is not enough time in the statute of limitations at that payment amount to full pay the tax liability. Okay, so that option is out there as well. For your taxpayer that is staring down the barrel of a PPIA, it is wise to run the RCP calculations and determine their eligibility for an offer in compromise. Now, all of these types of installment agreements can also be set up as a direct debit installment agreement, often for additional good treatment from the IRS. Okay? Pending status. Briefly want to talk about this. Pending installment agreement status provides protection from levy action. Okay? You can request an installment agreement through a variety of different means. You know, you can etch it on a stone tablet and drop it off at the office if you want. Okay? In my practice, I would always send installment agreement requests in triplicate. Certified mail return receipt, fax and keep the fax confirmation, and also leave the details on a voicemail to the revenue officer. That way they can never say they didn't get it. In order to have a valid installment agreement request, you must provide sufficient information to identify the taxpayer and the tax types and periods to be covered. You have to propose payment terms. For example, if the taxpayer has a seasonal business and the installment agreement payment is going to go up during their busy season and down during their slow season, you need to state that. The taxpayer also needs to be compliant with filing requirements and current with current period payment obligations. So they got to be making their estimated tax payments, they got to be making their federal tax deposits, they got to have their W-4 adjusted to have enough taken out from their paychecks to cover their current year liabilities. Okay, otherwise they're just not eligible for the payment plan. Those are the requirements to get pending status. I try to get my clients here as quickly as possible. And I should also point out, I have never once filed a Form 9465. If you are currently using that form to request your installment agreements and you're doing it based on the per form charge that's built into your tax prep software, stop it, because all you're doing is cheating yourself out of additional revenue. The value of the installment agreement service, even for a guaranteed installment agreement, is more valuable than the tax preparation that you're doing. Therefore, you should collect a separate fee for it. Now, what if the taxpayer is broke? Well, back in 1980, the IRS decided, you know what? We are simply going to remove from active collections inventory those cases that we don't think we can collect on. Okay? As a general rule, these accounts will be reported as C&C when the taxpayer has no assets or income which are, by law, subject to levy. However, if they have limited assets or income, but it is determined that levy action would create a hardship, the liability may also be reported as currently not collectible. A hardship exists if the levy action prevents the taxpayer from meeting basic necessary living expenses. In each case, a determination must be made as to whether the levy would result in actual hardship as distinguished from mere inconvenience. Okay? Yeah, Paul, don't use the 9465. Write a letter and charge money for it, okay? Unless you don't care about revenue. If you don't care about your revenue, then just ignore that. So, C&C is they have no income or assets that are subject to levy, or if they do, the levy action would create hardship. For example, retirement plans, 401ks, IRAs, even college saving plans, 529 plans and Coverdell plans. Those are all leviable, okay? The IRS can and does levy those assets. However, by policy, if the only thing that a retired taxpayer has to live on is the money in their IRA, what you do is you look at the life expectancy of the client minus their current age, divide that out by the assets in the retirement account, and then you apply the collection financial standards, which form the basic necessary living expenses, and you say, look, you can't levy this asset because the taxpayer is retired and this is all they have to live on for the next 20 years, okay? And this is what the numbers break out to applying the current collection financial standards, okay? Levying that asset would create a hardship. Therefore, put the taxpayer into CNC. Bam, done, okay? Even though they have the asset. When a taxpayer owns nearly nothing and there's no remaining income beyond what is required to live, they're probably eligible for CNC. The nice thing about CNC is that the clock on the 10-year statute of limitations doesn't stop, okay? And this is a resolution option unto itself. Just let the 10 years run out. Once the 10 years expires, the IRS can't do squat, okay? And the debt just goes away. So the statute of limitations can expire while they're in CNC status. Now, there's supposed to be an annual review of the taxpayer's financials. But because of all the budget and staffing issues, these can go for years without coming up, perhaps even never. This is simpler in the long term than an IA or an offer and compromise. It's just simpler for the client. But it is technically it is temporary, okay? And for true hardship cases, case closure is very simple and quick by IRS standards. A lot of these can be a one-call close. Paul asks, if you have a client currently in an installment agreement, can you get them moved into CNC? Absolutely. If the installment agreement payment is creating a financial hardship, and you can demonstrate that by applying the collection financial standards, or if the business is tanking and can no longer afford the IA payment, then absolutely. Because guess what? Businesses can be put into CNC as well, okay? It's a little bit more difficult, but not much, all right? So absolutely, if they can't afford the IA payment, move them to CNC. Now, of course, everybody wants to know about the pennies on the dollar program. Remember, this is the least commonly used resolution pathway. And there are actually 3 different types of offer and compromise. One is doubt as to liability. So this is the 656L, and is processed by the examination department. And this is when the taxpayer says, I don't owe this money, okay? There's the doubt as to collectability, which is processed by the OIC centers operated by collections. And this is the taxpayer saying, I can't pay this money. And then there are also ETA offers, which are also filed on the same 656 form as the doubt as to collectability, but you check the ETA box. And these are processed by examination, but by collection, but with input by exam and by IRS legal counsel. Effective tax administration offers are saying, I've got the money to pay the tax debt, but because of my special circumstances, you shouldn't make me pay it. That's what an ETA is, okay? Every single one of these, I'm sure that there are other scenarios, but every one of these that I have ever seen or heard about is related to a chronic medical condition where the taxpayer needs the assets to provide for health care, and so those are the ones that I've seen, okay? Reasonable collection potential, RCP. This is the bottom line number that if you walk through the worksheets in the Offer and Compromise 656 booklet, the 433A OIC or the 433B OIC, the bottom line number that you come up with that they expect as your offer amount is called reasonable collection potential. This represents the total amount that the IRS could collect from the taxpayer within either a 1 or 2 year window. It used to be either a 4 or 5 year window. It includes net equity in assets, including assets that cannot be seized, such as a primary residence. You know, the IRS requires a district court judge to sign off on a primary residence seizure. They hardly ever happen. So it's the quick sale value of the asset minus any loan amounts. That's what the IRS expects to see. They're taking a look at present and future income. They're looking at amounts collectible from third parties, such as a business's account receivable list. Okay, they're also taking into account the value of assets that were transferred after the tax liability arose, and in which a certificate of discharge was not properly received. The IRS is going to track down those asset transfers and tack on that money. Okay, the minimum offer amount is the total of all these monies. So again, eligibility for the offer and compromise program is purely, absolutely 100% mathematical, unless there's an effective tax administration argument to be made, and those are few and far between. So if your reasonable collection potential exceeds the tax liability, your client is not an OIC candidate unless they meet ETA criteria. Now, I highly recommend that you always calculate RCP. Always. Do a quick back of the envelope calculation of RCP, because guess what? Revenue officers do it. It also helps you quickly determine program eligibility. So if their reasonable collection potential is greater than the liability, then you're looking at a payment plan. If the RCP is less than the liability, then they're potentially an OIC candidate. If RCP is negative, then they're probably a CNC candidate. Okay? This is the fastest way to help you determine the best resolution option for your client, is to simply calculate RCP and compare it to the liability. All right. A couple of quick things, kind of unrelated. I guess it's sort of related. Effective March 27th, 2017, two things happened. One, the offer and compromise processing units, so Brookhaven, Long Island, Memphis, Houston, they are going to return 656 forms on accounts that have unfiled returns. So if you file an OIC application and the taxpayer still has unfiled returns, okay, they're going to keep the deposit you send in and kick back the application and never even log it, okay? And they're going to apply that deposit in the best interest of the government, so to the oldest tax liability. Do bear in mind that for offer and compromise purposes, a substitute for return, a 6020B, is a valid return, okay? An SFR is a valid return for OIC purposes, okay? So you don't necessarily always want to replace SFRs for that and a number of other reasons. Also, the new collection financial standards took effect. So take a look at, just do a Google search for IRS collection financial standards. That'll take you straight to the page. Across the board, most numbers went down, okay? Most numbers for allowable living expenses went down this year by depending on category, 5 to 15% reductions across the board. On average, they went down by 9% last year. Okay, so for 2 years in a row, the IRS is claiming that the cost of living in the United States for a middle-class family has gone down. Okay? Feel about that as you may. Real quick, appeals. Appeals is an independent division with the IRS that is tasked with preventing litigation. They handle a lot of different aspects of disputed tax liabilities. What you'll discover in your practice, you'll find two primary things that you're going to use appeals for. Number one is the CAP program, Collection Appeals Program. This is where you're going to do most of your levy release action, okay? So if a taxpayer gets levied, you file a 9423 so that you get your group manager conference, and then your appeals conference all has to happen within 5 days, and appeals decisions are binding on collections. So if appeals says to release the tax lien, or the levy, or the lien, then you get it released. This is the first place you should go in a levy situation, not taxpayer advocate. Taxpayer advocate is there to help you with IRS procedures that are broken. Okay, if you haven't gone through this procedure, appeals first, then taxpayer advocate is most often going to say, you didn't go to appeals yet. you didn't follow the IRS procedures, therefore there's nothing broken for us to look at. Go to appeals, okay? So file a cap first on most levy situations. And real quick, the CDP appeal, collection due process appeal, a lot of times you're going to file a CDP appeal on a final notice of intent to levy in order to kick your case away from a revenue officer and into appeals. Over the course of my career, over 50% of the installment agreements that I've negotiated for clients, the revenue officer didn't want to play ball. And so I had to get the installment agreement in appeals, okay? So over half my case resolutions have come out of appeals, not revenue officers in the field. So be aware of that opportunity when an LT11 or a letter 1058 shows up on your door for a client, that you have 30 days to file that CDP appeal. Now, we've barely scratched the surface here. Dan Henn, CPA, and I are going to have 5 more CECP webinars that we're doing in July, so be sure to check out the website freetaxcpe.com for those. And then also next Wednesday, if you're interested in the marketing side of things, you know, those of you that have kind of been living on Planet Jason for a while, there's not going to be anything new here. It's stuff you've all seen before. But if you are kind of new to my world and want kind of an introduction to the marketing processes to help you launch your IRS collections representation side of your business, then coming out on next Wednesday, I'll be doing a free 2-hour introduction to tax resolution marketing. Because don't forget, you know, services like tax preparation and bookkeeping, those are commodities, okay? And they don't really require much in the way of sales and marketing skill for you to sell those services. But optional services, especially services that people aren't as aware of, they require you to have a bit more sales and marketing knowledge and application, all right? So because of that, I think it's important that if you're going to be in this business, in the tax resolution business, you're going to be doing representation work for your clients, you have to become good at marketing, okay? So just go to taxresolutionwebinar.com and you can register for that webinar next week. And again, for those of you that have been around my world for a while, it'll all be repeat. There's nothing new there that you haven't seen before in the past couple of years. But if you want a refresher, come on by as well. All right, our last polling question. All right. Dan and I do a fair number of multi-day seminars teaching our level 1, 2, and 3 classes. So all of it is basically getting into the weeds, the nitty-gritty detail of everything I just talked about. We're planning out our fall 2017 and our 2018 schedule. So we're always curious, you know, how much of a radius out are you willing to drive for a 3-day seminar? Notice we do most of those at hotels, and so there are usually hotel rooms right upstairs. All right, so that's what I got for you today, folks. I really appreciate you being here. Hope that this was helpful. It gives you at least a little bit of an idea of kind of what the business looks like, what some of the casework processes look like. If you want to learn more, again, go to freetaxcpe.com. Dan and I will be doing more webinars here soon. And then also, if you want to participate in the tax resolution marketing webinar that we're doing next week, then go ahead and visit taxresolutionwebinar.com for that. All right. So again, thanks for being here. Really appreciate your time. And to close out the polling question, Um, Paul says, this was cool, my first time. Looking forward to learning from more. Hope to see you next Wednesday. Absolutely, Paul. Yeah, thank you for being here. Appreciate it. Stephen, you're too kind. Stephen says, you've done it again. I attended a presentation by a CPA for another organization in January. The CPA didn't say that you only file an OIC if the numbers support it. He told everyone else that it was his knowledge that was needed for your client referral and ethical presentation. Haha. Yeah, it's purely numbers based. Unless it's an ETA situation, which are even rarer than offers and compromise in general. Just so you guys know, the IRS only accepts us. You can count on one hand the number of ETA offers they accept most years. Okay, they're very few and far between. So yeah, most of them, doubt is collectability offers. They're mostly financially driven. Shirley, thank you. Glad you found it valuable. So I'll close out the polling question. Thank you everybody for being here. I hope you have a wonderful rest of your day, and be sure to check out the additional sessions we're doing here in the next few weeks. Thanks a lot. Bye-bye.